Welcome to the Silver and Metal IQ. I'm Peter, and today we're going to talk about something most people still don't understand: why silver and gold are not behaving like ordinary commodities anymore. Let me start with the truth. The paper pricing system is breaking. This is not a trend or a market cycle. This is a collision between financial fiction and physical reality. And once that collision happens, the price is no longer controlled by charts, ETFs, or trading algorithms. It's controlled by real metal in the real world. Right now, the biggest money in the world isn't trading on margin. They're not betting on leverage. They're not trying to get lucky with a short-term move. We're talking about sovereign wealth funds, governments, and major industrial buyers who are buying silver because they need it, not because they want a profit. Here's the key point. The market is no longer driven by speculation. It's driven by structural shortage. Mine supply has been declining for years. Demand is exploding, especially with AI, solar technology, military systems, and industrial expansion. The world is entering a phase where silver is becoming critical, and the buyers are competing for the same limited supply. So when you hear financial analysts say, "The top is in," you have to ask, what are they looking at? Because they are not looking at the real indicators, the ones that show stress in the system. They're looking at charts and ratios, not deliveries and lease rates. They're looking at headlines, not physical flows. And that's the point. This isn't a trade. This is a structural shift. The paper price is starting to lose its meaning because the physical supply is becoming scarce. When trust in paper promises breaks, people stop caring about future delivery. They want silver now. If you want to understand what's happening, you have to understand that this is not just a market move. It's a trust move. And when trust is gone, the system changes. Here's the truth most people don't understand. Price does not always equal reality. In markets like silver, the real truth is in the physical metal, not the paper contracts. In December, COMEX recorded the largest silver delivery in history, the biggest delivery ever for the month of December since 1974. That's not a small number. We're talking about millions of ounces moving into real hands. Not paper contracts, but physical metal being delivered. Now ask yourself, if silver is supposedly peaking or topping out, why would so much metal be delivered at the same time? The answer is simple: because the market is tight. When physical demand is high and supply is low, deliveries rise. People want metal. They want it now. They don't care about the paper price or the charts. They want the real thing. And here's the most important point. Paper price drops are no longer easing physical pressure. In a normal market, when the price drops, physical demand slows. But not now. Every time the price dips, physical buyers rush in and absorb the supply. That means the physical market is not reacting to price. It is reacting to scarcity. This is what makes the current situation so unique. Every engineered sell-off is met by aggressive physical buying. Every time the price goes down, registered inventories continue to shrink and lease rates spike. Lease rates are usually near zero, but when they surge into high single digits, it's a clear signal. Metal is scarce. This is not a top. This is structural stress. And if you're still listening to people who say the top is in, you have to understand. They are looking at the wrong indicators. Because in this market, the real signal is not the paper price. It's the physical demand, the deliveries, and the scarcity. Let's break this down in a simple way. When a major bank aggressively shorts silver in a market that is already tight, it's not a sign of confidence. It's a sign of desperation. Because shorting in a backward-dated market means you are betting against immediate physical demand while paying a premium for metal delivery today. That is not strategy, that is necessity. And here's the proof. TD Bank recently put on a large short position in silver. They even published a report predicting silver would drop to around $45. Then the market hit $92, and they got stopped out. That's not a mistake. That's forced buying. This is how accidents begin. When you short something that is in backwardation, you are essentially saying, I don't believe physical demand is real. But when the market is paying a premium for immediate delivery, it proves the opposite. Physical demand is not only real, it's urgent. So when banks do this, it's not because they are bullish or bearish. It's because they have no other choice. They are trapped in a system that requires them to pretend supply exists when it does not. This is not a market with unlimited liquidity anymore. And when the system runs out of flexibility, the only way to cover losses is forced buying. And forced buying is what creates sudden reversals. You can't short a market that's already tight and expect to win. It's like betting against gravity. The market is telling you something. We don't have enough metal. This is the real reason why the paper price doesn't control the market anymore. Physical demand is dominating. And if you think the top is in, remember this. Every time the paper price drops, physical stress increases. Every time a bank tries to suppress the price, physical buying intensifies. That's not bearish. That's structural shortage. And this is not 2011. This is not speculation. This is not leverage. This is the end of a paper-based pricing system colliding with physical reality. This is where people keep getting it wrong. They hear the word silver rally and immediately compare it to 2011. But that comparison misses the most important difference. In 2011, the market was dominated by leverage and speculation. Traders were betting with borrowed money, and when margins increased, they were forced to liquidate. The market collapsed because the system was built on paper bets. But today, the buyers are completely different. Today, the big money isn't trading on margin. They're not speculators. We're talking about sovereign wealth funds, governments, major corporations like Tesla and Samsung, and industrial buyers who need silver for real-world applications. This is not a trade. This is a strategic purchase, and the reason is simple. Silver is becoming critical. Mine supply has been declining for 6 years in a row, and industrial demand is exploding across the globe. The world is moving into an era of AI infrastructure, solar power, electrification, and military modernization. And all of these systems require silver. That means there is a real competition for the same limited metal. So when you hear people say, the top is in, ask yourself, are they considering that the supply is shrinking while demand is growing? You don't permanently top when supply is shrinking and demand is rising. That's not how markets work. And the same thing is true with gold. Gold isn't rising because it's trendy. It's rising because it is the only asset in the world that is no one's liability. Central banks buy gold not because they're emotional or chasing a trend. They buy it because they are buying trust. When a currency loses credibility, gold becomes the default safe asset. When interest costs surpass defense spending, you can clearly see the system's chosen path: inflation and debt expansion. That's why central banks are buying gold. That's why silver is being drained. And that's why paper promises are starting to show their cracks. This is not a speculative bubble. This is a structural shortage, and it is being driven by real industrial demand and real geopolitical necessity. And the moment you understand that, you'll realize this is not like 2011. This is a completely different market, a market where physical reality is finally winning. Most financial advisors still treat silver and gold like normal commodities, but they're missing the real signals. They look at charts, ratios, and headlines. They look at ETFs and stock-like behavior, but they don't look at the indicators that actually reveal stress in the system, like delivery volumes, lease rates, backwardation, and the physical flow of metal. And because they don't look at these indicators, they keep telling people the top is in, while the market is quietly being drained of physical metal. Here's the problem. By the time the system admits stress, the opportunity is already gone. The market doesn't warn you. It just changes. And right now, the most important change is that physical demand is absorbing every dip. Every time the paper price drops, physical buyers rush in. That's not normal. That's not a typical bull market. That's structural shortage. And the reason this is happening is because the metal is becoming critical for industry, technology, and national security. When a metal becomes critical, people don't buy it for profit. They buy it because they need it. Now let's talk about the biggest shift happening behind the scenes. Mainstream financial advisories are now openly discussing what was once considered taboo. the possibility of the US dollar losing reserve status. That's not just a theory anymore. It's being discussed in official reports. Some mainstream models are now suggesting that if gold were to replace the dollar's reserve standard, gold could reach $39,000 to $184,000 per ounce. That's not a conspiracy theory. That's mainstream financial modeling. And if you're still holding only paper claims, you need to understand the risk you're facing. Because here's the truth that nobody wants to say: bank deposits are unsecured loans. When you deposit money, you are not storing wealth. You are lending money to the bank. The bank can lend out most of your deposit, and the money isn't really there in the way people think. Policies can change overnight. Accounts can be closed without explanation. And when trust breaks, it doesn't come back politely. This is why people who treat silver and gold like speculative assets are missing the point. This isn't about a market cycle. This is about the collapse of trust in a system that's running out of credibility. If you're still listening to the talking heads who say the top is in, ask them if they've looked at delivery numbers, lease rates, and backwardation. Ask them if they understand that the physical market is telling a different story than the paper market. Because when trust erodes, gold rises by default, and silver follows as both a monetary metal and an industrial necessity. The real money is being made by people who understand that this isn't a trade, it's a transition. Now let's talk about the part most people don't want to hear. When you deposit money in a bank, you're not actually storing your cash. You're making an unsecured loan to the bank. That means the bank can lend out most of your money, keep only a fraction, and still call it your account. The money isn't sitting in a vault waiting for you. It's being used to generate income through lending, treasuries, and other financial operations. So when people say, "My money is safe in the bank," they are misunderstanding the system. And this is why bank policies can change overnight. Accounts can be frozen, closed, or restricted with no warning. This isn't theory, it's reality. I've personally experienced it. Years ago, a bank changed its policy and closed all of my business and personal accounts, including my children's accounts, without explanation. That's how the modern banking system operates. It's not about fairness, it's about control. And when a bank has the power to close your accounts without cause, you have to understand who truly owns your money. That's why the physical metal market matters so much right now. When trust in the financial system breaks, gold and silver become the default store of value. They are not liabilities. They are not promises. They are real, tangible assets that cannot be printed, debased, or manipulated forever. And when the system reaches the point where it can no longer support paper promises, the price of physical metal is the first thing that reacts. So here's the final warning. Don't wait until the system breaks before you take action. Don't rely on paper promises or financial advisors who only look at charts. Look at the physical reality. Look at the deliveries. Look at the lease rates. Look at the shrinking inventories. Because when the trust is gone, it doesn't come back. Financial disclaimer. The information in this video is for educational purposes only and should not be considered financial advice. Nothing presented here is a recommendation to buy or sell any asset. Always do your own research and consult a qualified financial advisor before making investment decisions.